because it is an innate nature for the market to disregard economic data as long as it can in order for it to do what it naturally wants to do, which is print money. So I don't want to take credit for this like I actually had this. But one of the things I do like to do is I like to get information for us, and when I hear something that can stick, I like to hold it. So the last 2 days, we've been having rallies at the end of the day. And so I'm always talking to Peter. I'm always having conversations with Peter about the market because, and it's crazy because he always tells me, Trap, I love talking to you. I love the way that you see the market. I love the way that you break it down. But I'm like, no, Peter, like, I'm only, a few years in it. It's nothing. I'm a puppy compared to the experience that you have, what you've seen. So I'm always, when he's talking, I'm always just like in awe of how he understands how the machine moves. And I think for me, in order to be great at the game, like, it's great to have a Peter. You know what I'm saying? It's great to have him because he's been in every recession. He's been in since, 85. He's been in them, 2008, 1995. He's seen the market go through so many things, and that experience alone is vital. So I asked him a question. I was like, Peter, like we've been having these rallies at the end of the day. Explain to me, why is that? Like, why is it going the way and it's going? And so, because I had an idea. My idea was the market is in such a vital place right now. A frantic place is a better word for me. The market is such a frantic place right now. It doesn't want to really sell off. It doesn't want to sell off because it's an innate nature for the market to go what? Up. Innate nature. The market by law wants to go up. It's kind of like a fish. A fish by law of nature want to go upstream except for the salmon. The salmon is the only fish that goes downstream. Every other fish wants to go upstream, right? All right, so here we go. So I felt like by 3 o'clock, the market got a feel for what it wanted. By the days in, so we got a days in rally. But Peter said, you're right, but let me tell you why. This was really good. So Peter is a market maker. Peter is a market maker. So a market maker is the person that stands between the market and the buyer. So there's buyers from the institutions, or there's buyers from hedge funds, and then there's the market, and then Peter is the guy in the middle who makes the transaction possible. Right? So on a daily basis, somebody can give Peter $1 billion. Like, here, put this in the market for me. And so what Peter has to do is, Peter has to orchestrate how that money flows. That's his job. That's why I love talking to him. So Peter said, Trap, let me tell you how this goes. And this is called public order flow. This is how this goes. So somebody give Peter $1 billion. Well, he said a hedge fund. So it says a hedge fund gives somebody $1 billion and say, yo, I need $1 billion put into the market, and this is how I need that to go. Throughout the day, you have periods where that billion has to go through the market, because you can't put the billion in all at once. Because if you put the billion in all at once, then you let everybody know what you're doing, right? And that is not what you want. So you have to secretly put the money in the market. So he said, what they do is, out of $1 billion, well, he told me how they do it, and I put a number on it. Because he said the majority of the billion will come at the end of the day, which is between 3 and 4. But in the beginning, he said between 10 and 11, we'll call this IP, initial position. And he said between 11 and 2, you manage the position. Right?
This is what he said.
He said between 10 and 11,
They take the
initial position, because you can't put the
1 billion in all at once.
So what he would do is, in the beginning, they may put 200 million. Now this is me putting the numbers together with him on the live, but then he confirmed. He was like, that is perfect. So I said, so in the beginning, Peter, that 10 to 12, you say, hey, here's the position, right? He said, now between, that's to get in. Because this 200 million, watch this, is going to get lost in, well, not even lost. I'm using another word. It's going to blend in with flow. Right? So he said the first 200 million will blend in with the flow of the market, what everybody else got going on. So the 200 million doesn't look, what's the word I'm going to use here? Conspicuous. Come on, word. Come on, word. Come on, word. Come on, word. You feel me? So then he was like, in here, 11 to 2, you'll go with 300 million, but watch this. The 300 million is only, what's the things y'all use? What's the things they use? What's the bots called? There you go. The 300 million will always be algo. From 11 to 2. If you notice, this was such an aha moment when he said this on the phone. I was like, oh, that's it. Because I always knew that from 3 to 4, like, I don't care what the market doing all day. From 3 to 4 is when I pay the most attention, and from 9:30 to 10:30 is when I pay the most attention to the market. It's when I pay the most attention. But Peter says, from 11 to 2, the other 300 million is algo money. Right? It's algo money. But you still have $500 million to deploy. Now watch this. This one, it was really, really good. Really good. He said, if the position is up in this hour, if the position is up in the 3 to 4 hour, this is when the remaining 500 million gets deployed, and that's how you get a rally at the end of the day. Because now at the end of the day, you can deploy the 500 million in tranches within the last hour. So let's say you got 60 minutes, so you break that down to what? 20-minute increments or 30-minute increments, right? So if you break it down to 20 minutes, 30 minutes, that's 250. 250 at 3, 250 at 345-ish, right? Or you can break it down into increments of maybe 125, you know what I'm saying? So I'm like, dang, that's really, I say, Pete, that was a, he said, and that's how you get end of the day rallies. Because you can't tip off what you're doing, because you don't want everybody, because if you tip everybody off to what you're doing, And now also, this is me thinking through it, if you tip everybody off what you're doing, it also creates now a position for people to come on the other side. Oh, George in that position right there? Bet. I'm about to knock his socks off. I'm about to squeeze him. Oh, George Bullish over here? So you incrementally put $1 billion in throughout one day, but you put it in different time spans. So remember, he said from 10 to 11, that's the initial position. From 11 to 2, 300 million can be spread through algorithm. And from 3 to 4, that last hour, they get to dispatch it all. So now he can call his people like, yo, we dispersed $1 billion into such and such, such and such. By the end of the day, this is made of this. That's so sweet. But watch this though. He said the market has had plenty of reasons to sell off. He said, Trap, the market has had plenty of reasons to sell off, but it hasn't. And it made me think about something. So as he said that, I said, Peter, I'm thinking in my mind, because I know the market already wants to go up, like I'm like, yo, the market always wants to go up. He was like, yes, it's designed to go up, Trap. That's what they want to do. He said, Trap, they've had so many reasons, so many situations to sell off, but they haven't. Think about it. It is June. We've had war, bombing, bank failure. I'll talk about that today. Inflation, jobs. We've had some things that can really cause the market to sell off, but yet we haven't. This is similar to the Roaring 20s. I want y'all to go look at the Roaring 20s on what was happening in the Roaring 20s. I need you to go do your research and homework on that to figure out what that was. Right? I want y'all to go look at that. But then he said, the consumer is stubborn. The consumer has said to the market, I will spend money. I will use credit. Even though inflation is high, even though banks are having watch this, high inflation makes it hard for banks to lend money. Okay, watch it. Because it's costing them a lot of money. It's costing them a lot of money to loan money. Go look at what's called a Fed fund rate. It's costing the bank a lot of money to loan money to growing companies. Now, even though the growing companies got to pay a lot, so now they not going to borrow as much as they will borrow at 5% as what they will borrow at 2% or what they will borrow at 0%. So now this is why in the market you don't see a lot of what? IPOs. I want this to make sense to y'all. I want this to make sense to y'all. If you go look at the Fed fund rate, that's the rate at which banks got to pay the loan money. So now they got to make that up by lending money to people, but they make more money from lending it to companies that won't grow their money. So now the company's going to borrow some money, but they're not going to borrow as much money to grow their company because of what it's costing them. So now they not borrowing as much money, which is why right now banks have over $500 billion in unrealized losses sitting on the balance sheet. We talking basic economics right here that you need to learn about how to play this game. So because banks can't lend money, and whether you realize it or not, yes, the small business is the life bloodline to the American economy, but also it is because banks push money into those small businesses as oxygen. And so if the banks can't give the small businesses money, those small businesses once was a Uber, once was a Microsoft, that was a small Amazon that grew huge because it got injected with money. Okay? Now watch this. Because that's not happening, this is a black eye to the game. And so because this is high, this is a black eye to the game. So the economy can't grow at the rate it wants to grow because the small businesses can't hire enough people because they gotta do what? Buckle down. Because big tech companies right now are doing what? Laying off by the hundreds. So also, that puts us in this situation. Jobs, credit. Well, how does credit play? Well, we understand right now, short-term credit is 21%. So people now have to use credit, but guess what? At 21%, you ain't swiping that thing as much as you would, but you swiping it a little bit more because why? Inflation is high. So even though you swiping less, it's costing you more. Let's go a little further though. Let's go a little bit further. But also, guess what? Housing. It costs more now to rent than to own. Way more. No, to own than to rent. It costs way more now to own than to rent. You have seen an influx. 37% of Americans have now did what? Downsized. 37% of Americans have now downsized. Why? It's not complicated. Right? It's not complicated. And I'm saying this because Peter told me this. I said, so when he told me this, I said, this makes sense. And because I had recorded that video the day before, I'm like, here's the reasons. But also, we've seen oil now drop 12%. This is a problem. So the market has every reason to sell off. But for some reason, we hitting all-time highs. Because it is an innate nature for the market to disregard economic data as long as it can in order for it to do what it naturally wants to do, which is print money. That's what it naturally wants to do. That's why they keep saying the market is resilient. That's why people keep saying it gotta crash. It gotta crash. It does. But it is not naturally what it wants to do. It'll pull back and look for reasons to do what? Run to bonds. We talked about this in our portfolio mastery class. Before the market crashes, it will find a reason to run to the bonds, which is why I told y'all look at the 10-year, because this tells us how much pressure is being put on the market. It tells us the sentiment of the market. So when you see the hitting 4.6, 4.7, 5.1, 5.3, understand the market is being frantic. It is trying to find a safe place to be because it does not truly want to crash. When a market crashes, it is a last resort.